On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets.
G'day team, hope everyone is well. That's another week behind us. Let's run through everything that happened, then let's turn our attention to what's coming up in the week ahead. Global share markets, pretty good in most places. In the US, the S&P 500 index was up another 0.9% last week. That was its sixth consecutive weekly rise. UK shares stronger still. The FTSE 100 index rose 1.3%. We also saw solid gains from European shares and Australian shares. In contrast, Japanese shares, emerging market shares fell back slightly, while here in New Zealand, the local NZX 50 index was marginally lower. Not by much, it was down 0.2%, and remember that did come on the back of two quite strong weeks. Local interest rates fell back slightly, at least at the short end of the curve. That came after the September inflation report was a little bit weaker than expected. We'll talk about that soon enough. The New Zealand 2-year swap rate declined 10 basis points, finished the week at 3.6%. The 5-year swap rate down a couple of basis points, finished the week at 3.7%. So just running through some of those key releases, we'll get to inflation. Before that, last week here in New Zealand, we had another housing market report from the Real Estate Institute. This covered the month of September, and it still reflected a fairly sluggish market, although there have been some signs of improvement. Nationwide sales volumes fell 3.3% from a month earlier, and they were down about 1% on the same month a year ago. The days to sell still quite high, 48 in Auckland, 50 elsewhere, so still higher than a strong market would reflect. The house price index did rise, though. That was good news. The national house price index up 1% in September. That was actually the first increase since back in February. National prices are now 2.7% higher than that May 2023 trough, but they're still about 16% below that 2021 peak. In Auckland, a little bit stronger in September, we saw prices increase 1.8%. That's actually the best month since November 2021, which was when the market peaked. So a good month for Auckland prices. Across the rest of the country, prices lifted a more modest 0.6%. So at a national level, prices are up 1%. That was dragged up by that strength in Auckland, and everywhere else, things were a little bit more subdued. We also saw the results of the latest global dairy trade auction last week. That was out early last Wednesday morning. Not a lot of change, to be honest. The headline index slipped 0.3%, so down ever so slightly. That index is up 13.2% so far this year. Prices have rebounded to the highest levels in 2 years, and Fonterra has increased its milk price forecast for this season. That's sitting at $9 now, which would be the second highest in history. So the dairy sector going pretty well. But the big news of last week was the September quarter inflation report. And this was good news. Inflation back in the RBNZ's band. For the quarter, the headline CPI was up 0.6%. That was slightly below market forecasts. Markets were expecting it to be up 0.7%. The Reserve Bank was expecting it to be up 0.8%, so a little softer than expected. And at an annual level, that means the headline CPI is running at an annual rate of 2.2%. Remember, the Reserve Bank has that target range of 1 to 3, and they really want it to be pretty close to 2, and that's exactly where it is, at 2.2. That's the lowest since March 2021, and that's well down from what we saw back in 2022, which is where it reached a multi-decade high of 7.3%. That was the highest we'd seen since 1990, so 32 years ago. So it's gone from 7.3 in 2022 right back to 2.2. So great news. The Reserve Bank will be very happy about that, and it's very close to that 2% midpoint. Now, when you look at the detail, there is a bit of a different story there. Tradables inflation, and that's imported inflation, actually fell 1.6% on an annual basis, so minus 1.6%, while non-tradables inflation, and that's domestic inflation, that is still going up more than we would like. That increased 4.9% on an annual basis. So that's still elevated, and it's higher than the Reserve Bank would like to see, but it's not as high as the Reserve Bank was expecting. So good news on the whole, even though there are some elements of price pressures that are still there, things moving in the right direction, and they're getting there more quickly than the Reserve Bank had expected. So what does that mean for the official cash rate? Well, it means it's going to keep coming down, and it's going to keep coming down quickly. There is one more meeting left for the Reserve Bank this year. That comes in late November, so it's in about 5 odd weeks' time. Markets see another 50 basis point cut to the OCR as a done deal. That seems assured, and I would agree with that. In fact, some people think you might even see a bigger 75 basis point move. And that sounds outlandish, but there actually is a case for that, because with inflation almost back to that target of 2%, the job looks done. So there's no reason to have such a restrictive OCR anymore. The neutral OCR is somewhere in that 2.5% to 3% zone. And at 4.75, we're still way above that. So there is a case for the Reserve Bank to pick up the pace and try and get closer to that 3% neutral rate. Another reason why they might consider that bigger move is they take a longer break than most over that summer Christmas period. We've got that last meeting in late November, and then our Reserve Bank doesn't meet again until mid-February. So there's almost a 3-month gap. And you compare that to the likes of the Federal Reserve in the US, they will meet in early November, but then they'll also meet in December and then in late January. So they'll have 2 more meetings that they'll get under their belt while we are on holiday, so to speak. So when you think about it from that perspective, there actually is a case for the Reserve Bank going bigger early to make up for the fact that they will be missing in action for 3 months. You know, who knows? I think if you were going to put money on it, you would say 50 seems more likely, but we can't rule out a bigger proactive 75 basis point move because of the fact that they have that extended break. The next big data point is the labour force report, the unemployment report. That will come in a couple of weeks' time in early November. And that could be something that does tip the balance. If that shows us that the labour market is weaker than expected, that unemployment is rising more quickly, that could spur the Reserve Bank into action. So watch this space. But at the very least, I think you will see another 50 basis point rate cut in late November. That would take the OCR to 4.25% heading into Christmas, and that would be fantastic for borrowers and for investors and for economic confidence. I think it will ensure that we drag ourselves out of recession as we head into 2025. So good news on that front. Right, what else? Well, while we're on the subject of central banks, the other big development last week was that we saw another interest rate cut from the European Central Bank. It cut its policy rate 25 basis points from 3.5% to 3.25%. So that was the third rate cut of this cycle, but it was the second meeting in a row that we've seen the ECB ease policy. They were originally expected to pause again. You know, they've sort of been going cut, pause, cut, pause. But the reason they decided to cut this time is because inflation has been falling more quickly than expected in Europe. So their annual inflation rate has fallen to 1.8%. So it's actually below that 2% target. That was in September. So Now they are saying, well, there could actually be more downside than upside risks to inflation. So they want to move a bit quicker and get interest rates down more aggressively. So that again is good news for borrowers in that part of the world, and it is a positive for investment markets and so forth. Their next meeting is in December, and then they've got another one in January. So I think you'll get two more cuts then, another 25, another 25. The ECB policy rate will be probably sitting at 2% by the middle of next year. So this is very much the theme everywhere. Rate cuts are certainly coming thick and fast. The one place that is sort of out of step is across the Tasman. We did have some labour force data last week, some unemployment data in Australia. That was stronger than expected. So the Reserve Bank in Australia had been expected to maybe wait until December before they cut rates for the first time. Now that's looking increasingly like it will be a 2025 story. So we might go to the end of the year with, in fact, we will end this year with a lower OCR than the Reserve Bank of Australia has. They're at 4.35%. That was their peak. We peaked at 5.5, so quite a bit higher. But because they're sitting tight and they haven't cut yet, and they probably won't until next year, and we are cutting, we've come all the way down from 5.5 to 4.75, and by the time it's Christmas, we'll either be at 4 or 4.25, but depending on what we see from our Reserve Bank, a 50 or a 75, and that will see us lower than the RBA cash rate. So that will be interesting. They are very much out of step with what you're seeing in the UK, in Europe, in New Zealand, and in the United States. Right, turning to the week ahead. And on the economic front, for me, the highlight will be the flash PMIs for October, flash purchasing managers indices. These will be out on Thursday, and they'll be the key release, I think, in terms of what is economic activity doing. The Australian measure is out at 11 o'clock New Zealand time on Thursday. The Japanese one comes out after lunch, 1:30 p.m. that same day. And then you'll get the PMIs for the UK, Europe, and the US overnight on Thursday evening. September PMIs, so a month earlier, they were pretty solid, although we did see the pace of global growth slow everywhere except for China, and China's sort of coming off a weaker period, so it's sort of going against the grain. The US still remained the strongest region, while you saw Japan, the UK, emerging markets, they continued to expand, but at a slower pace, and Europe and Australia kind of sort of stalled a little bit. So we'll be monitoring those to see what is the pulse of global growth looking like. We'll also be watching inflation indicators. In the US a month ago, there were a few signs that we might see a re-acceleration of inflation. So that's something to keep an eye on too. So global flash PMIs will be in focus on Thursday. That won't be the only thing to watch. We'll also get the Fed's Beige Book. We'll get European consumer confidence. We'll get the Tokyo CPI in Japan. So lots of bits and pieces to keep an eye on there. On the central bank front, the Bank of Canada has a monetary policy meeting that comes on Wednesday. Markets are expecting a 50 basis point rate cut from the Bank of Canada. We've also got annual meetings from the IMF, the International Monetary Fund, and the World Bank, and the BRICS Summit takes place in Russia. So leaders from India and so forth will be in Russia for that. So that will be interesting to watch and see anything comes out of that. Also on the international front, the reporting season will continue. We've got more than 100 S&P 500 companies scheduled to announce results, and plenty of others around the world too. Lots of highlights. Some of the names that I'll be keeping an eye on will include 3M, Boeing, Coca-Cola, Tesla. Tesla result will be interesting. That's on Wednesday. Unilever, UPS, Colgate-Palmolive. So something for everyone there. So far, with the reporting season still in the early days, but we're about 14 or 15% of the way through in the US. 64% of companies have beaten estimates at the revenue level, and about 79% have exceeded earnings expectations in terms of at the profit level. So it's been a bit of a mixed bag, but more good than bad. The US financials have continued to impress investors. We had good gains from the likes of Goldman Sachs and Morgan Stanley. That came on the back of a good result from JP Morgan the week before. Netflix was up strongly. The market liked that one. TSMC had a good result, Taiwan Semiconductor. In contrast, on the other side of the equation, the ASML result was a little disappointing. LVMH also suffered in the wake of weaker demand out of China. So as always, it's a mixed bag, but certainly more good than bad. Closer to home, not a whole lot of economic data. However, markets will tune into a speech from Reserve Bank Governor Adrian Orr to the Peterson Institute in Washington, D.C. on Wednesday. I think he's giving that speech at 1 o'clock on Wednesday in the US, which would equate to 6 a.m. on Thursday morning in New Zealand. So keep an eye out early Thursday morning for that. He's also giving a media interview to CNBC, which is Channel 91 if you've got Sky. I'm not sure what time that is taking place, but I think it's around the same time. So on Thursday, we'll probably get some comments from Mr. Orr. That will be interesting because we haven't heard from him since the inflation report last week. Remember that 50 basis point rate cut came before the inflation report that we saw last week. So it'll be interesting to get his take on that, especially as we look ahead to November. Is it a 50? Is it a 75? How is the bank going to deal with the fact that they've got almost 3 months off and a longer break than most? So investors will definitely be tuned into that. Also, a lot to monitor on the corporate front as well. There's quite a few annual meetings here in New Zealand and across the Tasman. So when companies have their annual meeting, they often give a trading update. So you do get a few tidbits about how activity is tracking, what they're seeing in their business. On Wednesday, it's quite a big day. Fletcher Building, Freightways, EBOS Group, Michael Hill, Property for Industry, all holding AGMs. Thursday, Chorus and Scalar up. Friday, Port of Tauranga, and across the Tasman, there's a few as well. Stockland on Monday, Transurban on Tuesday, APA Group, Brambles on Thursday, ResMed as well, got a quarterly result, and on Friday, Cleanaway and Cochlear. So plenty going on, lots to keep abreast of. Oh, before I finish, next weekend is Labour weekend, so a long weekend. I'm going to go away on holiday with the family for the long weekend, so apologies in advance. You won't get a podcast like this next week, and you won't get the report that goes along with it either, that our clients have access to, and it gives you a bit more detail and a few facts and figures and charts. I won't be here, so I won't be able to do either of those things. So I'll return the following week. Right, enjoy your week, team, and we'll talk again soon.
For more insights, visit craigsip.com.